With this, we move on to the last panel of the NextGen Virtual Summit on integration, innovation, and investment. The panelists for this session are Yagnesh Sanghrajka, founder and CFO, 100x VC, Ashish Fafadia, partner Blume Ventures, Rajesh Raju, managing director, Kalaari Capital. And the session will be moderated by Nandini Mansinghka, co-promoter and CEO, Mumbai Angels Network. Over to you, Nandini.
Thank you, Shivangi. So, the challenge of having the last session in a conference is always that we have to be the most interesting. Otherwise, the participants are going to say, okay, what's going on? So, and the good thing is that, I have such an interesting panel with me, is that we can look at the, the entire spectrum of how is it that we are investing, in this, in what is called next gen tech, and figure out what drives our decisions, what drives valuations, and what are the things that we say no to. So I think those are the things that we will, try our best to try and figure out as we go ahead with it. And so, Shivangi, do we have all the panelists on this thing? I'm not sure if I can see them on the. Shivangi?
Yeah, Nandini, I'm there.
Yeah. So
yes, we have everybody.
The names that Shivani took, I think all the names are here. Rajesh, myself, all the three.
Hey, Ashish, how are you?
Hi, Ashish.
Everybody's here.
Cool.
Hi, Rajesh.
Hi, Rajiv.
Cool.
Hi, guys.
So, hi. So, all right. So now what we will do is that if I can just go with each one of you and, ask you 2 or 3 questions, and let's keep the answers a little short so that we can cover all things. Is A, what do you define as next gen tech? And B, when you're looking at investing, what is driving your decision when you're looking at tech-based companies? So, Ashish, do you want to start?
Yeah, thank you, Nandini. Nandini, I will just go a little top down and share my thoughts. So when it comes to next gen investing, I think there are a bunch of large scale problem areas that need a fairly complex solution that builds out. The world has sorted out fairly when it comes to modes of communication, means of interaction. But we have yet to, there are many areas where we can leverage the infrastructure that has been built out to make lives easy, make sure education reaches the population. When I say education, not only we're talking about K-12, there are many dimensions within that. Where make sure that the underserved on the fintech side, bring the underbanked on the banking side, get investments out. So when you compare the 4 fundamental things, which is education, finance, fintech, health, infrastructure, logistics, the situation is right, and it is critical over the last 10 years and the next 10 to get to a point where the whole world has access to these basic necessities. Necessity to access quality healthcare, necessity for education, for financial products, being able to inculcate a certain savings pattern. So even the basics have not reached a significant part of the world's population. That becomes one critical factor to create opportunities and invest in those areas. And then there are all the other second level opportunities where it is media, entertainment, gaming, etc., which are opportune. So I think this is where I think broadly the investments would lie. Some of these would be enabling enterprises, which is what comes as a part of B2B. Some of them are directly aimed at making lives easy for the consumer, which is a B2C. So the focus is in that direction. To keep the answer short, I would just end it here and come to your second part, which is what all do we look for? So when it comes to these spaces, if a certain problem set is very large, then that's a starting point. When a VC is approaching a problem, it could be different for different investors. But essentially, when you're talking to an institution, the whole thrust is to go after a very large problem area where you can create a solution. The probability of the solution working out could be maybe 5%. But if successful, this is going to solve a very large white space. That is critical. I don't think VCs would be super excited by something that can have a 50-60% probability of success, but may not become magnificently big enough. So the fundamental thing is large market size. Can this become a mega play? And then the founder. So these are the three aspects.
What do you define as large? Like, we also do the same analysis, but I want to understand that from your perspective, when you say large, can you just give us some examples?
So rather than take a crack at the market size, because in some areas, if it's a B2B play and certain dynamics work, even $1 billion may be large enough. Some you might not need anything less than 5 or 10 billion. So rather than get into that complexity, let me just define it from the spectrum of the founder of the company, if that makes more sense. Which potentially one can't visualize that it can get to, on the B2B side, maybe $10 million of monthly run rate in terms of revenues, if it's a B2B business. Or on the B2C side, something that will be a problem which 10% or greater of the mass will adapt to, is not going to be large enough in the Indian context. Yeah, we have a large population, but how much of that population is actually going to be able to pay for a certain offering that a startup is offering? Within that, if you are able to target maybe 5 to 10% of the mass, it becomes meaningfully large enough. From there, I don't think we can say it has to be a unicorn and all that. Unicorns happens and are made. It's a combination of those factors. So I'll stop here and maybe switch it back to you.
So Rajesh, from your perspective, can you talk to us about, some of the tech investments that you have done and what drove the investments? What were you looking for? And
So the deep tech or the next gen topic we have today is interesting, and there's a lot of talk around it for Indian entrepreneurs to really focus on breakthrough technology, etc. I mean, if we talk about the fad around AI or blockchain, whatever the latest over the last couple of years, the fad has been, most of them tend to be horizontal in nature. Most of them, the basic building blocks are already available. And India has so many practical problems to solve. I'm not even sure whether we should be focusing on building the next best foundational AI algorithm or a new blockchain, right? I mean, we have enough available technology out there or the building blocks out there to horizontally apply those building blocks to many sectors, and can solve everyday problems that Indians face, whether Indian businesses or Indian consumers. So, like Ashish was mentioning, market opportunity has to be large. Unfortunately, the VC equation, how it works, high risk, high reward, and high risk because of the early stage nature, high risk because the entrepreneurs are not serial entrepreneurs typically in India. And India is still an emerging country. Its market is not mature enough to define the market properly, right? So there are many elements of risk. Taking that kind of risk, the reward better be big, and that's why there is so much focus on unicorns. And I'm sure that the term unicorn takes a big bashing, but it's always been the same equation. Not now, for the last 40-50 years that VCs have been around, right? So the big bang nature of unfortunately the risk reward that we play in, that's how it works. Having said that, what do we look for? I mean, for us primarily, and this is from 14 years of investing in India experience, entrepreneurs have been the biggest difference makers, right? And that's important. Focusing on entrepreneurs and choosing the right entrepreneur is important, and that's always a gut call in India, because how do you define a good entrepreneur from an average entrepreneur? There's no bad entrepreneurs, by the way. Any entrepreneur getting out there is taking tremendous amount of risk and putting everything on the line. But the successful entrepreneurs, how do you define them? What are the characteristics? We have done all kinds of permutations and combinations. We've done all kinds of regression analysis on characteristics of entrepreneurs. It's very hard to pinpoint that. But the gut and some of the key elements we look for, of course, the energy and passion that everyone talks about. One of the key elements that at least I focus on is the ability to sell for the entrepreneur. And why I say ability to sell, not the product or technology and everything, even though we are investing in technology, is because you can have the greatest product in technology, but if you cannot build the ecosystem that is required around you, it's impossible to build a great company. And what's the ecosystem? You need to, of course, attract capital. So you need to sell to investors. You need to sell to your customers, either the consumers or businesses. You need to sell to the employees or the great talent that you need to recruit. You need to sell to your partners. You need to build the entire ecosystem around you. And that comes from great ability to sell. And it's not the typical used car salesman ability I'm talking about. I'm talking about the subtleness in being able to convince the person sitting across you that they take away your passion when they leave the conversation, right? So that's the foremost thing that we look for. And the market opportunity being large, which I already covered. And then comes the product and technology. And it may seem counterintuitive investing in tech companies, and third in line is technology and the product. But that can always be made better. And technology and product, the stage where we invest, Series A is never great, right? It's impossible to have a great product already built, which we have been able to over time evolve and make it better and better. But the first two elements, market size and entrepreneur, are critical.
Yagnesh, so you actually walk in much earlier than most investors, and I think at times you walk in even earlier than at where we walk in as Mumbai Angels.
That's right.
So at that point, trying to look at a tech entrepreneur and actually figure out whether what they're trying to build is really a company or just a product, or even whether the entrepreneur has the ability to scale it up is a very tough thing to pinpoint. So what has been your experience? What are you looking for at that point, when most of the times maybe the company is just a business plan on paper?
Yeah, I think it's a very valid point you made, Nandini. We are the first ones in the grid. I mean, we are the first check writers. 100x basically writes the first check, so it's the highest risk that we take in a startup. So when you are looking at that kind of an entry situation, which is even pre-seed in our terms, I mean, there's a lot of word around seed, and seeds have become bigger. But we're talking about a pre-seed here so far as 100x is concerned. So, it's more of a discovery platform. So we claim ourselves as discovery platform guys. We basically look for founders and typically choose those founders who basically have a vision. So one is, of course, founders become more and more weightage, as early you go. So you enter in a company, you basically don't have past track record, right? So you basically have a business plan in front of you. You really don't know whether that'll work or not, because a lot of variables do come in, and we all know how many business plans have worked to the T. So you have to discount all of that. So basically what you have left in hand is the founder, the market opportunity, and whether he really is building something unique. These are the three things that probably make the decision that we take, and we choose our founders accordingly. And when we're talking about technology, of course, technology is paramount. It touches almost every sector. It's absolutely critical to have that in order to have scale. But we are seeing a lot of work happening in robotics. Health hygiene tech is the new word. India being touted as the pharmacy capital, you will see a lot of technology flowing into health tech. And when you say health tech, it is hygiene tech, both mental and physical. So we are looking at a lot of areas where these kind of trends are coming up, and founders are coming up with such unique and brilliant ideas. All that diligence that we have to basically do is figure out whether he can really make this big. Like, Ashish and Rajesh both spoke about the market opportunity. Does he really understand how market opportunity works? What is market opportunity? So if they are able to even pinpoint that number accurately. I mean, half of these guys obviously don't have a bigger roadmap. They have their basic thing is to survive, make it to that next milestone where, you know, I could take the deal to you guys or an Ashish to kind of say, boss, you know, please fund this. So, I mean, we only look at that, whether that founder or the team has that grit and the determination to kind of make it happen. Those are the things that we are looking at.
Ashish, you know, so like when we look at our portfolio in Mumbai Angels, yeah, and you know, I was just doing that exercise with the team to trying to actually define saying which of our companies are actually tech, and that becomes a very tough classification, you know, to say, because are you looking at a tech product or are you looking at a tech enabling, you know, business model? So when we looked at the whole thing, we said, okay, about 50% of our investments are tech. And I must, pinpoint here that we used to do a lot more tech investments before than we do now. Because today we have said, listen, there are so many opportunities that India as an economy has, you know, which is consumer, life sciences, etc., that we actually want to define it more as saying, okay, consumer and life sciences and not tech. Do you see a similar thing happening in your portfolio, or, you know, are you more, a fund which says it has to be primarily tech for me to be able to invest?
Sure. No, Nandini, it's a fair point. What, however, has mattered to us is that there has to be a tech spine to the business. It is perfectly fine that it might be a business where tech is at the back end of it, and there might be a combination of a very strong operating layer in the business. Because businesses of nature where you are organizing an otherwise disorganized market, there are enough opportunities in that as well.
Yeah.
And it is, of course, in over the last 2-3 years, these are marketed as data plays and all that. So without archingly relying on data and all that, we make our own assessment. But there will be those type of plays where tech is having as a backbone, as a framework. But it might be a strong integration between a hard market operation on the ground and an integration of tech at the back end. So far as that tech spine is there, we are fine with it. That said, there would be still 1 in every maybe 5 investments that we would make where it may not be there as a strong spine. It might be something where the offline element is pretty hard, or a business which is on the agri side. It becomes more opportunistic. So to avoid being very opportunistic, what we started to do over the last 2-3 years is get more thesis driven. So while in the first fund, the way we looked at was fairly opportunistic, something coming our way, if it's great founders, why don't we just park a small optionality and double down as they grow? Over the last few years, we have become more and more thesis driven. So if it is a non-tech spine, but we have a thesis, we have a view on how we are going to support the company, how we can make a difference to the lives and take them from point A to point B, and the team has the chops to be able to grow in that direction. Yeah, we are open, but those are more exceptions than the norm, is how I would like to put it.
Rajesh, in how big is your tech portfolio? Like, and you know, do you have a thing on saying pure tech portfolio and tech enabler? Do you look at it like that, or like, you know, like Ashish is saying, it's more the spine and how big is your tech?
The way we separate our portfolio is simply B2B versus B2C. Okay. And of course, B2B got muddled a little bit. Our definition of earlier B2B is product SaaS companies, right? Which is a traditional VC space. This whole consumer funding is only a last 20-year phenomena, by the way. Even in the US, until late 90s, there's nothing like a consumer company that used to be funded by VCs. It was pretty much deep tech, what we call pure tech, which is, you know, product companies, product platform, SaaS, now SaaS companies, cloud companies, right? So yeah, I mean, so we call non-product platform companies as B2C, addressing any consumer product or a service. And they tend to be never pure tech companies, right? You use technology to accelerate either the adoption of that particular service or the experience for the customer. So technology is only an enabler, and of course some of the great B2C consumer companies have tremendous technology also. If you take an Amazon, do you call that the Amazon, the e-commerce part I'm talking about, is that a tech enablement or deep tech? They have a lot of elements of deep tech in Amazon, right? So, but at the end of the day, what they're providing is simple commerce, and they're using technology to provide commerce solutions that have been around for thousands of years. That people were selling to, there was retail forever, and they have a better way to do retailing. That's all, right? So, so we separate them that way, and we consider our B2B or the product companies as the deep tech companies, and that's where we spend a lot of time in actually understanding the technology, the uniqueness, differentiation. Is this a price kind of an advantage that they're seeking, or they're a truly inherent deep tech advantage that they're seeking, right? Either way is fine. I think India, still we have labor arbitrage, and the price equation is also fine. So to simply answer your question, yeah, that's the way we look at our portfolio, consumer versus non-consumer.
Yagnesh, I'm going to just spin the question a little differently for you on this one. So, when we have done our investments recently, and when we say tech, we have actually started seeing these, whole new sectors that we are being able to invest in, like defense tech, space tech, med tech, so newer things which maybe were not that prolific, say, even a year back. And since you would be seeing, founders coming much earlier than even we do, are you also seeing a trend there where there are newer sectors or entrepreneurs coming up with newer segments which were not available, say, even 6 months back? What is the mix of tech entrepreneurs you're seeing?
Yeah, so we are seeing the same thing, Nandini. So basically, this whole new era of technology has brought in new terms, as well as founders bringing some of these new terms. We learn from founders actually some of these stuff. So retail tech, for example, I mean, one never knew what is retail tech. Now we have, like, for example, I'll just share some of the examples that from our portfolio companies that we have funded. So there's a company which is into B2B SaaS platform, enterprise and SMB, serving retail customers, can also be extended into other verticals, but purely using AI platforms to just help locate, or decide where should the retail outlets be, what is the best place to kind of be there, based on various studies and even satellite imaging technologies used. So, I mean, that is technically termed as retail tech. Now, we never knew this, and when we saw the company and we found it very interesting, so they are into retail tech. Another one is a voice vernacular AI platform, right? So now these are things that are now coming up. India's vernacular population is using more and more tech, as we know. We have one company in our portfolio which basically is converting, it's into conversational AI, and purely for vernacular, for a blue collared force. So, I mean, that is what you call as vernacular voice AI platform tech. So, I mean, all of that combines into this, and now we are seeing more and more companies into, obviously taking the help of robotic process automation, bringing it into the main foray, planning products around that, and also helping industries optimize, like warehousing solutions and stuff like that. So yeah, I mean, we're seeing all of that pretty much. Agritech has really surprisingly come up. We are seeing a lot of deals there, and we could wonder, I said, what is the intervention of technology in agritech? And one would be surprised at looking at how they are making a difference to farmers. So I mean, these things have come up, and I mean, that's agritech for you. So that's exactly what we are also seeing, and it's interesting, to study, to learn from founders, and how they are solving, problems of farmers, problems of blue collar worker force. That's where the country needs technology, and that's where these guys are applying it.
Ashish, I'm going to now go into another segment of the discussion, which I think so. We have several entrepreneurs on the summit, and we also have a lot of our members who are investors. And the biggest question that people have whenever we are looking at a tech company, which is maybe zero revenue or very little revenue, is of course valuations. So how do you actually value something where clearly when the founder comes to you, his or her understanding of the product or the passion of the product is like maybe 30 times yours, right? And then you are sitting there and saying, listen guys, where is the business plan, where is the sales plan, what is happening? So just some thoughts around how do you actually arrive at valuation for a tech, and a more and if a recent transaction that you've closed, even without giving names, if you could just give us some sense on how valuation was arrived at and some ballpark numbers, it will help us understand this better.
Sure. So, Nandini, when it comes to valuation, I think we have said this before and on panels like this as well, that, and I'm sure both Yagnesh and Rajesh will assertively agree, hopefully, that it's art as much as a science. And it needs a combination of top-down and bottoms-up effort to realize what is the best way to progress something. And even after the best of efforts, I know I'm starting with a caveat, but even after the best of efforts, you realize at times that the expectation of founders is somewhere around 2x of what your starting point is, which is okay, maybe justified, maybe you're not seeing something that the founder sees.
Yeah.
Let's be humble and admit that. Not every time the founder's passion is the overriding factor which drives valuation up in his head. Sometimes the conservatism and the learnings of the past do end up kind of tapering off that excitement and lead us to be a little more conservative, right? So with that overarching caveat, it is a combination of both top down and bottoms up. There is Indian ecosystem as it stands today has evolved fairly. Of course, I believe very strongly we are far from our peak. We will only get better from here on over the next 5-7 years, and that's where somewhere we'll reach our peak. But there are enough data available where you use a top-down method and say what you have broadly intuitively worked out in your head is commensurate. So you look back, what is the potential market size of this opportunity? You look at what similar oriented founders and companies have done in terms of scale. What are similar high-scaled transactions at a larger level in that space operating at? And you apply a slightly better and a slightly more generous multiple. You can't use the same multiples that you use at the growth stage. For companies that get valued at maybe 7x of ARR on the B2B side, where there is a fair bit of scale achieved, we can't put the same 7x. So we are using other art factors. What is the growth rate over the last 12 months? What are the markets that they have captured already? Is it an India-centric play on the B2B, or it's a global B2B play? So some of those will have a higher multiple. If it's a B2B business and it has a strong proposition in the US and they have already got to rolling well, a couple of clients signed up, they will have a premium vis-a-vis businesses which are here. It's not a bias versus against India or a bias in favor of US. But the fact of the matter is that Indian corporates and enterprise do have a fair bit of challenge in penetrating and selling enterprise-linked solutions. So these factors will have a lot of play when you're trying to attribute multiples on valuations. But yeah, I would definitely want to admit that even at our stage, more challenging at Yagnesh's stage, we do face this challenge, and it is trying to figure out some intuitive combinations of numbers. But over a period of time, with 125, 130 our own transactions to go back and validate, I would like to say that we have not been off by more than 15-20% either ways. There are times when we would have undervalued a company maybe 15-20%, and there are occasions when we would have been snubbed by a follow-on VC who says, "Oh, you guys valued it by a little extra." It's okay, but the range has not been more than 15-20%. Whether it's pricing around, pricing an internal bridge round, putting a cap, we've not been off by that range. But yeah, we have been off.
Rajesh, is there a difference in valuation on what you would call tech first companies and where tech is being used as an enabler? So do you see that, like, does having an overlay of tech allow the founder to ask for a higher valuation in your
Again, going back to my earlier comment about how we bucket companies, if you look at pure tech companies, the bucket of B2B product platform, SaaS, cloud companies I talked about earlier, the path to profitability is much more clear, and the margin structures have not dramatically changed from earlier software investments in 70s, 80s, and 90s, where the gross margins were 98, 99%, because the CD that you gave to your customer was the only cost of goods sold, right? To SaaS, of course, I think 15, 20% of infrastructure costs are coming into the picture, but roughly 80 to 90% is the gross margin in those companies, right? So the amount of investment needed, if the product is truly great, breakthrough kind of a technology, is very little. So at the end of the day, it boils down to profitability, whatever stage you're looking at a company, right? And so the path to profitability is easier. A path to growth needs less capital in those product companies. So you look at that set of companies differently. And if you feel that your $3, $4, $5 million check you're writing is all the money that they need, and they're asking for 10 times, 20 times whatever the ARR they had, then it's again a gut call. You can actually digest that and say, fine. I mean, I see that, I see what they're saying, and I'll pay up, and if you can believe it. But on the consumer side, when you're talking about the negative gross margins to single-digit gross margins, most often, it becomes extremely difficult. Now you're talking about a company that you're investing, let's say, 1 crore of monthly revenue that they come to us with, maybe a couple of crores these days at Series A. You know that this company can actually be worth something, be profitable, and can be IPO'd or eventual somebody recognizes it as a great company. It has to reach $1 billion in revenue minimum, right? Otherwise, it's impossible to tag this as a great company and get to profitability. So when you need that kind of scale, you need a lot of capital. You need multiple rounds of funding. So every round of funding is basically a stumbling block where a company could actually falter and die. Because there's no funding round, consumer companies typically die. Either you scale or die, right? There's no B2B kind of I'll survive for the next 10 years if I have to mode. So there, again, the valuation becomes extremely difficult. You look at, if I invested at a $10 million valuation, will the Series B guy invest at $30, $40 million valuation? And what do I need to do with the money that I'm investing to get to the next stage? And you need to remember that there is going to be Series C, D, E, F, G after that, right? So you also take into account the amount of dilution, not just we're going to take, but the entrepreneur is going to take. You don't want the entrepreneur to take, let's say, a seed check, an angel check, and then a Series A check. By that time, they're like diluted 30, 40%. We typically don't touch companies which already have diluted 30, 40% by the time they come to us, right? Because we know that the amount of dilution, the founders consistently, they have conflicts with investors when they get into those single-digit shareholding, right? Yeah. So you need to take all those things into account and guide yourself on valuation and guide the entrepreneurs. And I think entrepreneurs are much better equipped these days because they can go and talk to a lot of successful entrepreneurs, and there are a lot of the big company entrepreneurs are mentoring these guys. So they're a lot more reasonable. They listen to logic and they listen to this dilution methodology. I think we have had more success in coming up with valuation numbers rather than putting multiples on revenues, which I think at the stage we invest at is not as relevant.
Yagnesh, how about you? What is what drives your valuation discussions with your thing? And since you are the first investor, the point that Rajesh is making about how much is going to be with the entrepreneur after, say, 6 rounds of funding. Is that something that you look at? What is your driving philosophy around it?
Yeah. So for us, it's as I said, it's at our stage when we enter into companies, they probably are at a pilot stage a couple of successful pilots with probably a couple of POCs, and then some use cases and some revenue. Okay, and these are not in the ballpark ranges of anything that an Ashish or Rajesh looks at, right? So and I wanted to add the point to what Ashish just made. It's completely probably an art right now at our stage than a science. When you have numbers behind you, you basically apply maths and science and then work out valuation numbers. However tough they may be, they are still probably achievable in a situation where you have a track record. In our cases, 99% cases are such that they have revenues because we don't touch pre-revenue companies as a rule, not as an exception. But yeah, the exceptions could be, there could be some exceptions to the rule. However, most have just started. So they are at their initial 4 or 5 months, 6 months of revenue, and we have very less data to kind of track revenues. We can just probably work around with founders and see what they're working at, what kind of customers they have, what quality of customers they have, whether they really have attrition. And there are very less data points, as you will agree, for us to kind of work on that. So what we have done is we've done a very simple thing. We've introduced an instrument called iSafe, as you're aware, which actually doesn't value the company as of now. It's a simple agreement for future equity. So whatever we invest through iSafe is basically with no equity stake right now. We are promised a stake in the future. So it's completely a founder-friendly kind of document, which basically enables the founder to raise money quickly without getting into a debate of valuation. Because let's face it, some of the founders who come to us have no case of valuation. I mean, they could have anything in their mind, but then we are at a different place. And if they are at a different place, it's never going to work out. So typically what then happens is then an iSafe comes to the rescue, and it is a simple instrument which helps bridge this particular valuation discussion. And we issue a check, or we invest ending up between anything between 25 lakhs to a crore for a simple future equity. And it is not an equity that happens right now. So it's a convertible, works as CCPS, but there is no valuation there, which kind of helps the founder to raise money quickly without a valuation. He doesn't really have to worry about that. He can take the money, go to his next milestone, or whatever that can help the next round of funding. So that, and we've seen that successfully, in our class one. Almost half of our class one companies have already raised next rounds, either from angels or from family offices or from wherever. So they've been able to raise funds purely, and some of them are again through iSafe. In fact, the second round also happened through iSafe. They're at that stage where they can be valued fairly. The word important here is fairly and not valuing. So till they reach a particular stage where there can be arguments back and forth to do a valuation, they still haven't probably reached that stage, and they still need a crore more or a 2 crore more to kind of reach that stage. And this instrument basically helps that. So that's what we found. I mean, we've launched this for the last 1 year since 100x started, and we've been very successful in acceptance from founders for iSafe, and it really has helped them raise next rounds as well. So that's been our experience.
Ashish, I think we now have about 15 minutes. So just, So two questions here. One is, has your strategy changed because of COVID? And, are you seeing a difference in how you are approaching, investments? Are you seeing a change in how the entrepreneur is thinking? And a similar question over there is that because of COVID or the current situation, have the exits in your portfolio slowed down? Are you seeing a change there?
Sure. So, Nandini, I think whenever us or people from the fraternity are looking at investment and considering pulling the trigger, the thought process and the view is broadly a 10-year thought process. And the reason I am consciously saying it 10 years, though we put in our exit clauses as 5 and 6 years, because as the time of exit, if the essential looking at some kind of a person who's going to come and buy, who will have another 2 or 3 years as a horizon. So broadly, until and unless you can convince yourself that this is a fundamental bet and not just something which is being done for the sake of tactical valuation game. You will pull the trigger on that fundamental premise. In our thought process and sentiment, the 10-year view has not changed. We see the current situation from an India context as a blip, which is of a temporary or a semi or a little temporary plus kind of a nature. I'm not trying to suggest at all that we are going to be safe and sound and everything will be hunky-dory by the end of the year. Mentally, we have budgeted that it will take till end of next year for situation to start returning to normalcy. And when I say normalcy, I mean while consumption patterns will start sticking out and become better, but at the end of the day, the whole cycle starting to come back, people getting the deserved premia on the valuation, people attributing the due credit to what the founder has built. All of that ain't coming back until Jan to March quarter of 2022. However, nothing beyond that it's not likely to stay thereafter forever. So given that in our eyes, that 10-year view has not changed, we are not taking a view that, okay, let's stop. What we are definitely conscious of is that if a company is going to be invested into today, that company again comes back to fundraising in the next 12 months or so, it is going to be having possible impact of valuation as well. So either we are saying we'll fund it properly the way it should be, which is 18-24 month kind of a timeline, or we will be a little conservative and say, okay, let's play valuation in a certain channel. Already committed, they have gone through, nothing has been revisited. So broadly, the mood and tempo has not gone down in the ecosystem where people are running for life or running for safety. That overall temperament stands broadly, and we are no different. On your second point, exits, well, I think it is still not happened that we were on the verge of an exit and somebody has come and say, okay, we'll postpone it. We were not in that frame with any transaction. But yeah, broadly, it will postpone for sure. Today, when we launch out, even if we go out and say we want to sell a particular stake or a founder is ready for an M&A, it will have to wait for another 6 to 12 months or so. And if it does go through, it will have an impact on valuation for sure. One can't be completely isolated. While the mood will be there, you will be okay to cut a check. One can't simply say, no, I will play hunky-dory and say as if nothing has happened. It will play its part on the way you structure an investment or an exit. Maybe you will do a little more tranching. Maybe you will value it a little more conservatively. Those factors may play out. But broadly, either it will be delayed by a bit or it will come back to its full momentum in about 2021, kind of an end of time, 2021 time frame. It will not have a severe downside impact.
Rajesh, what's your view on it? Have you become more conservative on investing? Have the valuation discussions become different? What's your view on, how long this is going to last?
So to be honest, we are talking to companies, and we've definitely slowed down, or at least we have not focused as much into investing compared to worrying about our own portfolio.
Mm-hmm.
And when you have a large portfolio and the first month after the lockdown, it was quite chaotic. So we were trying to go through the entire portfolio and handhold each and every company to properly do the scenario planning. And when there is so much uncertainty, you have to plan for various scenarios, right? And one of the worst things that can happen is if you're planning on fundraising, you are already fundraising, or you were planning on fundraising in the near future. Those timelines are definitely extended, right? So how do you stretch your cash to not 3 to 6 months? How do you stretch it to 12 to 18 months? Unfortunately, that whole exercise has taken us a long time. I think the portfolio is fairly okay now, but that's been the focus on survival. So some companies were doing extremely well through COVID, so you don't have to worry about them. So they're getting enough interest from investors, and they'll be fine. Companies which were doing extremely well, but were hurt by the lockdown. is what we worried about. How do you stretch their cash flows, and how do you maybe do some bridge rounds to help those good companies, and companies which are struggling pre-COVID and got worse during COVID. I think it's a question of how do you bring the experiences that you've had. A lot of bad experiences you go through as a VC, more than good, you see bad, and during other crises, we have seen this, right? But this is much worse than any other crisis we have ever seen. So how do you bring that knowledge, those examples to the entrepreneurs, and show them the reality that sometimes you have to take care of other things. It's not about the returns to yourself, returns to the investors. Sometimes what you built, product and service, can't disappear because the company is dying because of COVID, right? So how do you get them to look at M&A as a possible avenue to take, which they were never thinking pre-COVID, right? So those conversations are tough, but I think there are a lot of opportunistic M&As that are going on now. We are trying to do our best to make sure that those values are not rock bottom, but there will be companies in every portfolio where you have to find a home, and those are some of the tougher journeys for our portfolio companies to take because of this. But other than that, I think we take a longer term view, like Ashish is saying, and this is going to be a 12 to 18 month kind of phenomena. And if it's longer than that, the whole world is going to go into a crisis, and forget about venture capitalists and entrepreneurs. We're all in trouble. So, but at least we are planning, whether fundraising or exits or cash needs or investments. We're looking at a plan for a bad economy for the next 12 months at least. We will start looking at new investments, but our focus primarily has been cleaning up the portfolio so far.
So, Yagnesh, over to you. Just as a, data point, for us at Mumbai Angels, we've actually seen more investments happen over the last 3 months. So this is a very, I think there is a difference in how individual H&I angel investors are looking at investments right now versus how funds are, because, I think last 3 months we've done more deals than we've done, in the last year. So that's the kind of change we are seeing. We're seeing more people wanting to become members with us. They're becoming more active. We managed to raise much larger rounds in individual companies. Like we managed to raise $1 million for a company, which was like a first that we ever did. So I think there is a difference in how individuals are looking at it versus funds. So Yagnesh, do you have a similar view? Are you seeing a similar trend? What are your thoughts on it?
Yeah, so I can completely relate to you, Nandini. Just as an example to share with everyone here, we've also seen a lot of deals, a lot of our portfolio companies more talk to these, HNIs and family offices. I completely agree that there has been a flurry of activity in terms of HNIs and angel investors and family offices alike in taking interest in evaluating new deals. In fact, some of our portfolio companies raised money in the last 3 months. Of course, they were at their cycle where, post our VC pitch day, they took a little bit of time in terms of using our funds to reach the next milestone. But contrary to what we expected during COVID times, we really were pleasantly surprised at the interest level. A lot of deals could get completed. So they are on that path of, to their next journey. And thankfully, of course, none of our 20 portfolio companies so far have seen any mortality, because in our case, one would expect quite close to mortality because of less runway present with them. But thankfully, I've spent a lot of time with portfolio companies already in terms of making sure their business plans were revised. They cut down their costs well in time to kind of make sure that they extend their runway by at least another 6 to 9 months. And then that could give them a chance to kind of, raise that next round that they are looking at once things return to normal. But, we don't know, none of us knows when that will happen, but at least that gives them a fair chance to survive. And in so far as the new class is concerned, I mean, we are already actively looking at deals, and we will be closing our class 2 pretty soon. So yeah, I mean, we are actively investing every day. I mean, we are evaluating new deals, and they are coming. So I mean, we are looking at a lot of interesting companies. So that's, and we are at an entry phase right now. So exits are, of course, no discussions for us right now. We're just busy building companies and investing in them.
Super, super. So I think we're just running out of time, but Ashish, there is a question that's come from one of our members. I just wanted you to take like a quick shot at it, and then we would just close it. Is to say, are you seeing the ecosystem maturing over the last 5-6 years, where the number of investments, the ratio of investments that have gone bad in your portfolio have actually started reducing, both because the ecosystem has become more mature, the founders have become more mature, our ability to look at data before we invest, so just question on saying, is the ratio lesser? He's not audible, Shivangi.
Check, could you just please unmute? Just give me a minute, ma'am. Yeah.
Yeah. Thank you, Shivangi. If I can, I mean to answer your question directly, and I will. But before that, I think if I can just permitted to define the term maturity. I think the maturity of the system is a function of the exits we churn out, not by exiting one company which is exiting to the other with a stock swap. There are enough of those cases where two overvalued companies have had a stock swap. The real value discovery still is unknown. Real test and maturity of the startup ecosystem at its peak would be when companies are able to hit the public markets and stand the test of time on the bourses. And I said earlier that we are a few years away from there. I definitely don't see in an environment like this how a company will go down that path. And definitely it's 2 years away when a company will take a shot at it. And thereafter, maybe 2-3 years for it to prove its choppiness of the market, stand the pressure of the analysts and all that. To answer your question, yeah, we have seen that the ecosystem in general has definitely, India has been a land of resilient founders. This is a good and a bad both. When you talk to some people who have seen the US ecosystem very strongly, very deeply, they would say that we need to learn to fail fast in the venture space. If things are not working out, would you just stretch your runway for the heck of it and die maybe 9 months later, or would you conclude today and give it a best shot and see what happens? So that's a good and bad both. We have been beneficiaries of companies that we have done, and I think in a couple of them, even MA is there as a co-investor, where the founders have really stayed on put beyond the first round of capital. They have not raised anything. So we are seeing that founders have been resilient and they're willing to give it all. And the loss ratios are partly going down because the check sizes are a little up. Our ability to bridge them from time and again also is higher. And we have consciously taken the call that, yeah, if needed, we will stand and bridge and not look at validation. If the company is doing well, provided the founder can convince that he can track to a profitable outcome by taking the bridge. It has to be a bridge to somewhere. Even those initiatives or efforts prolong or create lesser losses. So it's a combination of factors, but yeah, it's led by the founders and some work on our side both, rather than just us.
Super. So I think we've run out of time, but if I could just go around the panel and if there are some 30-second words of wisdom you want to give to your audience. Rajesh, you want to go?
So the tech so-called inflection point, people have been waiting for that, and I think few segments in India, I think truly have that inflection point because of COVID. Unfortunately, from a health crisis, but I think few segments are going to be helped, like EdTech, health tech, gaming, and all those things that are seeing a true inflection point. So the true product and SaaS investments I was talking about have been average at best over the last 10, 15 years in India. They've been actually a bad segment to invest in. But over the last 2, 3 years, that inflection point has come. I believe the domestic market, where for these products to be absorbed domestically is very, very important. And the domestic CIOs and CTOs are buying technology now. I think companies are laying the foundation before they have to go and attack global markets, which was the only avenue before. So they're going with more mature products and references, customer references when they go to global markets. So that's a good sign. So there are a lot of good elements. But at the end of the day, I leave everyone with one thought. The Indian, whether venture ecosystem or investment ecosystem or entrepreneurial ecosystem is a long way to go before maturity. And it has nothing to do with all the people sitting around here, around the table. Fundamentally, it has to do with India, right? And we are running ahead of the pace at which India is growing, and whether the consumers or businesses need to have money in their pockets to spend. And we're investing into companies and expecting them to become large companies when they can't get that money out of anyone's pocket, right? So I think India fundamentally has to grow its wealth, and we will see the whole ecosystem mature, whether it is investing or growing or scaling or exiting. All those things will fall in place as India matures. So we need to be patient.
Yagnesh, your 30 seconds.
Yeah, so I really feel, just wanted to share with all of you, India is a land of opportunities, and there are immense, just like US used to be the case, 2 decades back. And I think India has the next 2 decades with them. There will be a lot of technology intervention in almost all the businesses. So regardless of any vertical or any horizontal, India is such a large market that any opportunity you see seems large enough. So the whole, whatever will win will be the one that actually, scales up. You will feel a lot of opportunity of scaling up, but then truly, if you don't really spend time diligencing well, you could fall into a trap where it could seem large, but it isn't. So I think the key here is to kind of look at real problems and not something that is around us and may not be scalable. So I think that's the whole thing. But it's a good time to invest, as they say, in bad times. So you really, from an investor focus here, it is a good time to evaluate deals. We have to be careful, of course, about which companies we choose to invest. But if we really do invest, and there's a lot of capital available, there's no doubt, right? So if the right capital goes, India could really see good unicorns coming out, at least, maybe 50, 60 of them in the next 5 years. And that may be just a conservative number. You will be surprised, pessimism grows faster, and then optimism also grows faster. So that is something that somebody has to keep in mind.
Super. Ashish, we're completely out of time, but just your 30 seconds.
So we have, I think, very valid comments on the macro, and I agree with Yagnesh and Rajesh. I'll just focus on the micro a bit. So I think this is a great time for founders, and I believe there are quite a few founders here as well. This is a great time for founders to obsess and focus on the problem and not the solution. Because if the problem has been identified right, then you can easily get running to your customers for funding. And I think that's the most sustainable form of funding that you can get. Investors is about seasonality a bit, and that is true for even startups as well. But if you get your focus on the problem right and identify the customer's pain point right, they will come and fund you in form of revenue. So I think it's a great time to focus on that. If you have the luxury to do that, you're lucky, and make yourself bigger and proud. Thanks.
Thank you. Shivangi, over to you.
Sure. Thank you, Nandini, and thank you, Yagnesh, Ashish, and Rajesh, for the insights and the investor trend spotting in this sector. We're sorry we couldn't take some of the last minute questions. We'll try and address it in the series coming up in the next month. With this, we draw an end to the Mumbai Angels Network's NextGen Virtual Summit. I would like to thank all our esteemed panelists who have been with us over the last 3 hours for lending their time and invaluable insights to the summit. I would also like to thank our sponsors, supply chain and logistics partner, HSFI, health and wellness partner, Blue Ocean Studios, gaming partner, Seran Games, Brick Walls, ecosystem partners, iCreate, EIT, TPI, and FIRE, media partners, Startups News, FYI, for their valuable support to make this a success, and all our participants, members, and founders, portfolio companies for attending this and being an interactive and engaging audience. Do we look forward to seeing you once we announce our July calendar. Stay tuned, stay safe, and take care. Good evening.
Thank you. Thank you.
Thank you. Stay safe, guys.